another question. This one's for Mr. Christensen. I assume he can follow along here. But both Mr. Organ and Mr. Epstein in the second panel raised the concerns that short positions exceed the physical supply. The second panel kind of argued that that wasn't a concern. Are you concerned that the shorts will not be able to deliver if called upon?
No, I'm not at all concerned. For one thing, it's been persistently that way for decades. Another thing is that there are any number of mechanisms allowing for cash settlements and problems. And the third thing is, as many people who are actually knowledgeable about the silver market and the gold market have testified today, almost all of those short positions are in fact hedges. The short futures positions are hedges offsetting long positions in the OTC market. So I don't really see a concern there.
Mr. Organ, would you like to respond?
I do see a risk on this, and I think it's a risk that we have to be very, very careful of as countries like China and South Korea, Russia start demanding and taking physical delivery of their gold and moving it offshore to their shores and putting pressures on on the COMEX. And we will probably come to a point in time where we will have a failure to deliver.
No, who are you?
Okay.
I don't know. No, I said no.
Oh, you said no?
I don't know who is this?
I'm Adrian Douglas. I'm assisting Harvey.
All right, sir. Yes.
So is my microphone on?
Yes.
I'd just like to make a comment about, we're talking about the futures market, hedging the physical market. But if you look at the physical market, the LBMA, it trades 20 million ounces of gold per day on a net basis, which is $22 billion. That's $5.4 trillion a year. That's half the size of the U.S. economy. If you take the gross amount, it's about 1.5 times the U.S. economy. That is not trading 100% backed metal. It's a fractional reserve basis. So, you can tell that from the LBMA's website because they trade in unallocated accounts. And if you look at their definition of unallocated account, they say you're an unsecured creditor. Well, if it's unallocated, if you buy 100 tons of gold, even if you don't have the serial numbers, you should have 100 tons of gold. So how can you be an unsecured creditor? Well, it's because it's fractional reserve accounting. I mean, you can't trade that much gold. It doesn't exist in the world. So the people who are hedging these positions on LBMA are essentially, it's paper hedging paper. And Bart Chilton uses the expression, stop the Ponzimonium. You know, this is a Ponzi scheme. Because gold is a unique commodity, and people have mentioned this, that it's left in the vault, it's not consumed. That means that most people trust the bullion banks to hold their gold, and they trade it on a ledger entry. So one of the issues we've got to address here is the size of the LBMA and the OTC markets, which are supposedly backing these positions which are hedging, but it's paper backing paper.
I guess I get time. I don't have any other questions. Commissioner Dunn.
Thank you, Mr. Chairman. Mr. Christensen, I appreciate the difficulty of trying to do this by remote, but at the end of your testimony, you begin talking about bona fide hedge exemptions for commercial traders must be part of position limits, and not to grant hedge exemptions to swap dealers would be devastating to exchanges' liquidity and price discovery capacity, and got into who determines what is legitimate or not. Could you amplify on that a bit and what you see as the danger there?
I could definitely amplify on it. Amplifying on it a bit is a little bit more difficult because it's a very big subject. The first thing is precious metals, copper, other metals, energies, they're all traded internationally, and these are fungible commodities by and large. I mean, there's been a lot of strange things that have been misspoken about the relevant, the difference between the retail market and the wholesale market, and we don't have time to really go over those, I don't think. But the fact of the matter is, excuse me, I'm in a building that has motion-sensitive lights, and it doesn't recognize what I do as human activity.
Those were your words, not anybody here.
Yeah. No, actually, they were my wife's. If you start putting position limits on bona fide hedgers, for example, bullion banks, and the previous fellow was talking about hedges of paper on paper, and that's exactly right. Precious metals are financial assets, and like currencies and T-bills and T-bonds, they trade in the multiples of 100 times the underlying physical. And when people buy and sell those, they are voting and they're giving an economic view of the world, or a view of the economic world as they see it. And when you start saying to a bank, okay, I have a number of people, actually, let's go back to a concrete example of Mr. Organ. He was talking about August of 2008, when there was an explosion of the short positions in gold and silver held by bullion banks on the futures market. And he seemed to imply that that was somehow or other driving the price down. If you understand how those bullion banks run their books, the reason they had an explosion of their short position was because they were selling gold and silver hand over fist in the forward market, in the physical market, and in the OTC option market. Everyone in the world was buying physical gold everywhere in the world. The bullion bankers that stand as market makers were selling or making commitments to sell them material, and they had to hedge themselves. And they were using the futures markets to do that. If you put position limits on the futures markets, they will have to find some other mechanism to hedge themselves. And they will. Someone will provide that market, because it's a big world out there.
Jeffrey, I'm going to cut you off because I want to ask one other question of Mr. Org.
Go ahead.
All right, I'm sorry. Mr. Organ, in your testimony, you really posed a whole series of questions. It's saying, how do you conclude that such large and increasing short positions in gold could not be manipulative?